I'm still relatively new to real estate. In my first year and a half, people would throw around the word depreciation, and I would smile and nod my head and act like I knew what it was about, and I did not. So for anybody listening to this, can you give what is depreciation?
Yeah, so depreciation, basically the IRS allows us to write off the purchase price of the building over time.
Even though you get a loan.
Yes, yeah. So the way they look at it is, hey, you got a building, there's wear and tear, right? So you're going to be able to write it off, that wear and tear. So they allow you to take the depreciation regardless of whether the property is going up in value or down in value, right? It's just the rule. You get to take depreciation. And irrespective of how much money you irrespective of how much cash you spend. So if we are talking about $1 million property, you get the same depreciation whether you put the $1 million down all cash or you did it with no money down. It's exactly the same. If $1 million is the building purchase price, that's what we get to write off. So it's really amazing, when you hear people talk about, I think Robert Kiyosaki talks about this a lot, that his wealth was built on debt and taxes. Yeah. This is exactly what he's talking about, right? Debt. Using the bank or investors' money to get that $1 million property, that turns into tax benefit of depreciation for you. We look at it as a paper loss, right? Because you're not actually losing money. You're just writing off that purchase price over time, and you can utilize that to offset the rental income you generate.
Hey, real quick, the Better Life Podcast today is sponsored also by Open Door Capitals. And the reason I bring that up right now is because I actually have a free white paper that I wrote all about how the rich pay little to no taxes. It basically, everything Amanda just said, I outline a bunch of it in this white paper that you can look at, how like Donald Trump paid like $750 in tax the year he became president. I pay ridiculously nothing, pretty much, in taxes, despite making a ridiculously decent amount of money. And so if you want to learn how that works and how it works, whether you're an active investor, whether you're somebody like Cam, whether you're a syndicator, or whether you're a passive investor, that's right, we actually pass through a lot of the depreciation to investors. So you can learn how that all works by going to odcfund.com/tax. odcfund.com/tax, or by just going to Instagram and go to Beardy Brandon, shoot me a DM, and just use the word tax, TAX, and it'll automatically send you a copy of the white paper. I think you'll like it. All right. So depreciation, is that something everybody, Amanda, should do? If they own a bunch of rentals, even single family houses, we talk about a lot in the commercial world, but should they be doing it with single family houses?
For sure. Depreciation, I think, contrary to popular belief, you have to take depreciation. There are some really bad advice from CPAs who say, oh, don't take depreciation because you don't benefit from it. It's actually a requirement. So if you invest in real estate, you have to take depreciation on your rental properties. If you don't and you sell, the IRS is still going to calculate it as if you took depreciation. But beyond depreciation, right, there's this concept called cost segregation or accelerated depreciation. And that's where we say, okay, instead of writing off this building purchase price over multiple years, usually 27 and a half years, how can we tweak the number so we're writing off more earlier upfront rather than equally over 27 and a half years? And I think that's what you're referring to when people say, oh, the accelerated depreciation is only for commercial real estate, large properties, multifamily. But in fact, it's actually available for single families as well. We have a lot of clients in single family homes. Short-term rental space is a really, really great one. Because again, depreciation is looking at the purchase price of a property, not the size of a property. So we can have $1 million single family home that could yield you really, really great tax savings, right? So it's always, again, cost benefit. What is it going to cost me to do this accelerated depreciation, and how much am I actually going to save in taxes? That's how we make the decision on whether it makes sense to do it or not.
And I know we're going to talk about it a little bit later on the syndication, but this is the beauty of depreciation is if you're a passive investor investing in other people's, you actually get to benefit also from that depreciation. That depreciation flows through up to the owners, right? And so that's one of the nice things. I get that question all the time. It's like, well, if I'm a passive investor, am I going to get the same depreciation benefits? Like, yes, you are the owner of the LLC, and you're going to have that proportionate depreciation on your taxes as a passive investor.
Yeah, it's actually easier for passive investors too, right? Because all the tax strategies is done at the syndication level. Yeah. So you as a passive investor don't have to decide whether to do it, go out and get it done. You just getting a K1 with that tax benefit nicely wrapped in a bow, and then you get to utilize it.
Yeah, that's amazing. This also brings up a really important point here. that I'll throw out here is that when you're in real estate, especially at this level, we're talking about kind of this middle ground where like you're an active real estate investor or whatever, it's so important to get attorneys and CPAs who specialize in real estate investing, right? Because like, I mean, I hear it all the time. I'm sure you do too. Where like a client will come to you, Amanda, and be like, yeah, like my last CPA said you can't do X, Y, Z. And you're like, of course you can do X, Y, Z. Or like, oh yeah, they said I can just take this thing. No, you can't take that thing. Because like the tax code is what, like 4 billion pages long. Like nobody can understand all of it.
Research shows.
Yeah. Studies show it's 4 billion pages long. So like knowing somebody like that's your area of focus, you're going to get way, way, way better advice by a real estate focused CPA than you are. Same with a real estate focused attorney.
It's the same thing. It's like the same thing as, the analogy I like to give is the medical professional. Like you have a general practitioner and they know a little bit about everything. But if you go into your general practitioner and you have a specific issue, they're going to send you the specialty. If you have a heart problem, they're going to send you a cardiologist. The cardiologist may know a little bit about, gastroenterology or whatever, but they are focused on a specific thing. And it's the same thing with CPAs. There are CPAs like Amanda who they just know the tax code as it pertains to real estate. They don't have to go look it up. A lot of others that don't own real estate, actually probably one of the great questions to ask your CPA is like, do you own real estate? Because if they own real estate, they know that really well.
That's a great point.
Asking that question when you're interviewing CPAs is important. But like you said, there's I think it's 7,500, not quite 4 billion. It's 7,500 pages of taxes. But not all CPAs know that. Other CPAs might be expert in oil and gas provisions and all the tax benefits from oil and gas. Other ones might be, something else. So that's an important point.
Yeah. I mean, we work with investors a lot too who kind of real estate is their main wealth building vehicle, but that's not necessarily their business. So they might be like a doctor with a medical practice, but also doing real estate. So it's, like we can work with them in that, hey, we'll help you with the real estate side. How do you use real estate to offset your medical income? But you can always still retain, like, Mauricio said, that other specialist who deals with the medical side, right? Or whatever your other business is too.
Yeah, well, on a related question then, maybe it's a good time to talk about real estate professionals, right? At this level, if you're doing 100 flips a year, 50 flips a year, 20 flips a year, you're probably a real estate professional. If you're a landlord, you're probably one, but maybe not. If you have a full-time job, you might not be. So what is a real estate professional? Why is it important? How do you become one? And tell us all about it.
Yeah, so in the tax world, there's a set of rules called the passive activity loss rules. No one likes to talk about it because it's not sexy. It's not talking about paying no tax. It's the opposite. So basically the IRS says, hey, if real estate is your side gig, basically, and you make a lot of money, and they define a lot of money as over $150,000, right? If you make over $150,000 and real estate is not your main thing, and you have rental losses, then those losses are considered passive losses, which means that I can still use depreciation and all that to offset taxes on my rental income, right? But if I still have a loss after I've wiped out my rental income, I can't use it to offset my W-2 income or income from my business. Why? Because real estate is not my main thing. It's kind of like my side gig. So that's usually the standard rule, unless if you or your spouse is a real estate professional. So in other words, if you are a real estate professional, then your rental losses can offset all types of income, even though you're a high income earner. So if you're meeting someone who's a doctor who makes $500,000 a year and they said, I don't pay any taxes through rentals, that means very likely their spouse is a real estate professional.
Because if your spouse is, then you both are.
Then yes, if your spouse is, then you can use the rental losses against both of your income.
Yeah, which is why we're launching the new real estate professional lover.com, where it's a dating service.
Realestatematch.com.
Realestatematch.com, where we will hook you up with a real estate professional if you're a rich person, and you can now claim it as well, just for $10,997.
And if you're poor, and if you're a newbie real estate investor, now you can meet a rich doctor.
Exactly. That's exactly. We market to rich doctors. So this is I'm an investor. So Cam, both you and your wife are actively like full-time real estate. You guys are in it. It's stupid for you guys to still be married.
What are you going to say?
Separate. Go marry doctors each and have the doctors pay you like $100,000 a year. Because it's just a
side hustle.
It's just you guys can have a side hustle each to get married.
Platonic way, is that the right word?
Yeah, sure. Yeah. It's just a friendship.
You guys can remain friends with benefits.
Yeah, exactly.
Lexi and I,
you guys can
remain friends with benefits,
and
but then
the marriage,
the marriage is just for real estate tax professional tax for the doctor.
And they just have to pay me 50% of the taxes they save.
Exactly. They pay you a percentage of the taxes they save.
We could cost seg some stuff.
Do you think that was illegal?
I thought Mark Cuban was investing in this.
I think he is.
I thought he was.
We were going to pitch him on
Shark Tank
last week. Yeah, last week.